So I would want us to do this question, which was tested last semester, May 2019, question number 5B. May 2019, question number 5B. It was a very simple question. May 2019, question number 5B. Question number 5B. So you're told Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes during the last several years. In addition, it has used little debt, having a debt ratio of 25%. If the acquisition would be implemented, Excellent Limited could operate Best Limited as a separate, wholly owned subsidiary. This will increase Excellent Limited's gearing ratio to 40%. So the gearing ratio going up to 40%. The following is a forecasted financial data for Best Limited over the next 5 years. So they've given us net sales, operating costs, selling and administration costs, and then we have acceptable investment project which costs those amounts. The risk-free rate of return is 8% and the debt is considered to be risk-free. The firm's levered equity beta after acquisition is estimated at 0.8. After 5 years, the net cash flow, after 5 years, the net cash flow, after 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. 6% per annum in perpetuity, indefinitely. The corporation tax rate, we are told, is 30%. The firm's gross profit margin is 40%. Best Limited in cars, fixed financing cost of 2 million per annum. The firm's equity shares and the bonds are currently trading at par. Trading at par. So they want us to determine the maximum price payable to acquire Best Limited using the discounted cash flow, discounted free cash flow basis. So the key term here is free cash flow basis. Now, ladies and gentlemen, there are quite low-hanging fruits here that I'll be able to harvest very fast. For example, I can see that these people want me to calculate WACC. They want me to calculate cost of capital, which I shall be using to discount my cash flows here, my cash flows. So how do I do this? First of all, I'll give them cost of equity. Give them cost of equity using CPA. Give them cost of equity using CPA. Why have I settled for CPA here? I've settled for CPA because of the language that they've given me. I can see there is a risk-free rate of return. I can see equity beta. So remember, CPA, cost of equity, will be given by us taking the risk-free rate of return into, we have the market returns minus risk-free multiplied by beta equity. So the risk-free rate of return given in this question is 8%. 8%. So we have 8% here, plus the market returns in this question, expected market return. Expected return of the market portfolio is 13%. So we have here 13%, minus the risk-free rate of return. Risk-free rate of return, which is 8%, into beta equity. Beta equity has been given here as 0.8. Beta equity has been given here as 0.8. So then this one will be 0.08 plus, into brackets here, 0.13 minus 0.08 close times 0.8, which gives us 0.12, which is the same as 12%. Now the cost of debt has been given expressly. The cost of debt, the risk-free rate of return is 8%, and the debt itself is considered to be risk-free. Therefore, cost of debt is 8%. Cost of debt is 8%. In that case here then, our WACC will be weight of equity, cost of equity, plus weight of debt, cost of debt. And remember, cost of debt is normally after taxation, less tax. Now, the weights, how do we get weights? The weights. So fortunately, they have given us the gearing ratio, which is 40%. This gearing ratio, if you can recall, gearing ratio basically is debt all over debt plus equity. So meaning that if they give us that this gearing ratio is 40 over 100, what they are telling us is that the weight of debt is on top, is 0.4. And if the weight of debt is 0.4, then the weight of equity will be 0. What here? 0.6. The weight of equity will be 0.6. If that is the case, then our WACC, I simply come and plug in the figures here. We have the weight of equity, which is 0.6 times cost of equity, which we have up here, 12%, plus weight of debt, 0.4, times cost of debt. What do we have here as cost of debt? 8%. This one here will be multiplied by 0.6. How did I get this 0.6? It's 1 minus tax. And the tax is 40%. The tax, they give us tax figure. No, the tax figure is 30%. Corporation tax rate is 30%. So we have here this being 0.7 because this is 1 minus 30%, which will give us 0.7 like that. So please come and give us this figure. So then this one here will be 0.6 times 0.12 plus 0.4 times 0.08 times 0.7, which gives us 0.0944 like that, which is basically 9.44%. So this 9.44% is quite key to us because it is the question, or rather it's the rate which we shall be using to value the farm using discounted cash flow method.